Hi everyone, I'm Gabriel Ratana. I'm filling in for Jason today. For the last 6 years, I've served as a money mentor with the Money Multiplier. But more than that, I'm someone who just knows what it feels like to be trapped by systems that weren't built for us. I used to believe the same things most of us were taught growing up. Go to school, get good grades, get a good job, build good credit, get on the good side of banks so they can lend you money. And that's the way to build wealth, is to save, to defer, to hope. That belief system led me to frustration, stress, and a life that looked successful from the outside but felt hollow on the inside. Then I discovered the infinite banking concept and everything changed when I met Brent in 2014. I did not get started until 2015. I had to prepare myself to practice per se. I started investing in different things. I invested in a course to learn how to invest in real estate, but I started to just really see that the ultimate form you want to be in real estate is to be the bank. And also the contractors are the ones that make all the money. But today I'm going to talk about some case studies, mainly like my story with this idea, with this concept. And so I titled it, I have my banking system in place. Now what? Okay. I talked to Jason and Patty to see what, like the best way to serve you guys while I fill in for Jason. And we thought it'd be good to go over this. Some of you have questions about what to do now that you guys do have policies, or if you're still on the fence about getting a policy, you get to see some in action. Okay, so the first thing I just want to remind everyone, just keep it simple. There's three steps to this. Number one is compound. And like Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. The second step is to become your own banker and master the game money by controlling the banking function in your life. Number three is to use your bank to self-finance your life, your assets, your businesses, your experiences, and invest in the things that you love. So that's what I've done with my policies. I've first took my savings, I put it into this forced automatic saving system with an infinite banking policy because that's the best way to purchase really anything in life, and we want to use it to purchase assets. I saw this picture on, I think it was Instagram, and this is one of the most fundamental concepts you want to learn is purchasing things with your policy, and you become a wealth creator instead of having the sinking fund method or as a lender where if you're saving up for a car and it's $25,000 for a car, maybe you save up monthly or yearly, you have to save up maybe for 5 years $5,000 a month and or $5,000 a year, and now you have the 25,000. But once you buy the car, that account goes to zero and you have to start over. So year one you have 5,000, year two you have 10,000, 15, 20, 25, then you buy the car and then it goes to zero. If you're a borrower, you do the opposite. You don't wait 5 years to get a car. You need the car now, but you're going to have to pay interest. So you because basically go in the negative for your net worth. So you go negative maybe $30,000, and now you're probably paying about 6,000 a year and end up paying about 4 or 5,000 in interest instead of as a saver. So you spend more money there. But if you borrow from yourself, from an infinite banking policy, because of the way the compounding interest works over time, once you play honest banker and pay back those policy loans, your cash value has not only increased from the guarantees, but from the dividends that are compounding to buy you more insurance. Okay, so we want to just keep this in mind that as time progresses, our net worth and our assets are going to be going up. And for buying a income producing asset, we want to keep some things in mind. And I think Warren Buffett said this: buy low, sell high, never lose any money. So if you don't, and Brent says this one too, is pigs get fed, hogs get slaughtered. Don't get too greedy. Don't look to get rich on just one deal. You want to get good at this by practicing. You have to practice. And once you do it and you get to learn what kind of deals you like, what you don't like, what you understand, what you don't understand. You want to invest in things that you like and understand and that you can execute effectively, okay? So today we're going to learn how to stack cash producing assets, okay? So the first thing that I did, this is my first policy. So it was 20,000 plus a $17,000 dump in. I put that in, and this was actually my policy. So it was 37,500. And the first year I had 26,020 available in cash value. Okay, this is one of the cash flow analysis. And then from there, we want to, the first thing I wanted to do was just do what Brent was doing, and is to lend money. And I had an opportunity to lend it to a friend. I'll go into that in a second. But this is how the money moves. The money goes into a policy, it starts to grow, and it's uninterrupted compounding. So I'm going to leverage that policy loan and do what a bank does. So a bank is literally just flipping money. They buy low and they sell high. They're paying their depositors, say in this example, 5%, and then they're charging 10% on the loan. Okay, so to do a just an example, $10,000, the profit would be 1,000 minus 500, so they would make $500 in that 1 year, or $60 per month. Okay, so this is how the profit's calculated for a bank. So how much money does this bank need to earn 50,000 per year? You'd have to have $1 million in your cash value available in the loan. You take that out, and if you loan it at 10%, then that's where your 5% for the 50,000 for the year would be. Okay. So I started with not a million, I started with 26,020 of cash value that I could access. Another way to look at this is you want to think about what's the cost of the money. So for $10,000, say that was one of my first loans, the cost for me to use that money is $500 per year, or $41 per month, or because it's simple interest, this is how it's calculated. It's based on per day, 139 per day. So I had a friend. Oh, okay. Before I get into that, so a bank is a business, and businesses need customers. Okay, a bank needs to keep their money moving by lending money to businesses and people. And I connected with a friend who was looking for transitional funding. She was trying to buy a real estate portfolio, and she needed an additional $10,000. She already had a term sheet from a bank. She was ready to close, but she needed like 10 more thousand dollars. So I let her borrow that with a deal that it was 20% just flat rate, not 20% on a yearly basis. It was just, I would give her $10,000. She would give me back $12,000. And if she was late, so she was going to hold the money for 60 days. If she was late, I would have gotten 22.5%. Okay, so here the loan is an asset. It's a liability to her, but it's an asset for my family bank. This was one of the first deals I did. So I took the money, I put in a whole life policy. The policy was, that's where I got the funding, and that goes to the family bank. I ended up making the loan to my friend Cindy, and then she went and did this real estate project. Okay, so I'm gonna show you the numbers on this one. The revenue, so I told you she was a little bit late. I think it was about 4 months. She went 2 months over, and I'm not gonna lie, it was a little nerve-wracking. I thought I was gonna lose my money, but she ended up finally paying, and I probably should have done a little more due diligence on this project. So the revenue was 2250, and the cost to borrow the money was, so $10,000 for 4 months from the policy. I paid $166.66 in interest. Okay, so that's the cost for me. And then the profit, since I made 2250, you subtract the expenses, 166. So my profit was 2,083 and 34 cents. Okay, so that was there. So how much more did I make than the insurance company? So Ratana Family Bank made 2,083. The insurance company made 166. So I made 12.5 times what it cost me, basically. So to me, this was a good return. I have not done one this good since then, and I've kind of stayed away from lending because I don't really want to do things that put my money at risk. I didn't have any kind of mortgage or instrument like that to put a lien on properties. So I think that's what made me the most nervous, was just not having that. It was just a loan for her to close on the portfolio. Okay. But anyway, I got my money, and so I moved on. So I started with the $26,020 of cash value that I could access through policy loans. After paying back the policy loan, I have 26,020 plus the 2,083. So in total, I have 28,103 and 34 cents. Okay. So then I did a seller finance deal. I didn't quite have all the money for this one, so I did this with a partner. We split in half. The purchase price was 170,000, and it was seller financing. So we did a down payment of $50,000, and he held a balance of 120,000 at 5%. So here I didn't have to go through a bank, which was really cool. The deal we did a fast close, and it was mine. So I brought in 25,000 to the table. My partner brought in 25,000, and we started cash flowing right away. It was already fully rented. It was 3 units, and there was no renovation on this one. So it cost us about 1,700 a month in it's 27,000 for the gross rent. It should be 2,700. So it was about $1,000 a month in cash flow. I owned half, so I got about $500 a month in cash flow. So I did this one, taking the money from the policy, going through my banking system, and using that and putting it to work. So this one was a pretty good one. I own half with a partner, so the cost I had it for 3 years, and then we sold it. The cost to borrow 25,000 for 36 months from the policy was 3,750. So it was loan. I just put GRLC. So at 10%. So the family bank earned 3750. And here, so now I basically replaced Cindy in this deal. Okay. So I saw her doing good. So I just basically took the same structure. So I, again, my savings go into the policy loans it to the bank creates the promissory note, the asset to the LLC, and then the LLC goes and does a project. It goes and makes money, gets money from someone else, and that comes back into the system. We pay back the loan, so all that gets replenished, and then whatever's left in the profits go basically just go to me, and then I run it back through the system because in an LLC, you just get taxed on the income basically at a personal level. So it goes to me, and then I take it, and then I start putting it back into policies. So right now we're doing one case study at a time. I'm going to show you how they all connect. The next one I did was an Airbnb deal. This one, my uncle moved to Costa Rica and basically was working from there. And he had a home here and it was fully furnished. And I actually just started paying him rent and use that. So when you're trying to make win-win deals with people, you got to think, what they want. Think, how you can help them. And as a landlord, what do they want? They want to get paid on time and they want someone to take good care of their house. Okay, so as being an Airbnb host, I could offer that to him. I told him, Uncle, I'll pay you guaranteed rent up front. The cleaning lady will leave the home pristine after each guest, ensuring it is rent ready or ready to sell at your convenience. So he took me up on it. There's very little risk on my part. The rent was 2,000 per month, okay? And it would do a revenue of about 3,000 to 4,500 per month. What's cool about Airbnb, they have millions of users and they're already used to using the platform. They do take some big fees, and as long as you don't mess up your profile, you can just expect it to be a little bit consistent unless there's just no demand in your area. Okay, but if you provide a good house, there's a huge shortage of housing. So temporary short-term rentals can be a good option. By renting, I didn't have to come up with maybe 40,000, 50,000, 100,000 for a down payment on a house and then have to pay a mortgage. I just paid the rent. So my startup cost was $1,000. So it was prorated for half of the month. The home was fully furnished, so I did not have to invest any money into that. And then 2 weeks before I even had to pay my rent, someone booked for 10 days in April for $1,500. So I paid the cleaning lady 100, I paid my uncle 1,000, and then I kept 400. So I was in profit the first month. And then I averaged between $1,000 to $3,000 per month. Each of these deals, they're not going to make you rich, but by running the money through the policies, you're able to start your compounding. You're going to make way more than if you are putting your money into risky instruments. And the best part is you gain experience. So if you like one of these types of deals, you can just keep doing more. Here, the constraint is having reliable cleaning companies. The cleaning lady is really good, but when she was busy or couldn't do a same day turnover, I just couldn't keep up with the volume to be more profitable. So I had to find other cleaning ladies, but in cleaning companies, but I just never found one that was as affordable and that I could trust. With her, she basically does everything, so it's very passive on my part. And with all the different things that have going on, it would have basically been like starting a cleaning company with how much you have to schedule and then hire, and it was a huge mess. So I do this one still, but it's very part-time. It's made me about 45,000 to date. With basically my startup cost was $1,000 for rent, but I also paid $750 for an online course for a friend of mine who I knew who's teaching how to do Airbnb and short-term rentals. So if you don't know how to do something, pay for education. That could be a very good way of using your policy loans. Here was another one I did in Baltimore. The purchase price was 35,000, the renovation was 40,000. And this was, I also own half of it, so I did it half with that same other partner. 4 units for this one, and this one was really nice cash flow, 2,000 per month was bringing in. And so I just kind of did the same thing. The money goes in the policy gets lent, the money in the policy gets leveraged by my bank to create a loan to my LLC, and then the LLC goes and does the project, and the money gets recycled back in. Okay. So this was back in 2018 to 2024. The cash flow, I ended up bringing in about $36,000. So that was just on my end. And I put that all into policies. So my policy, the first one you saw was 20,000 a year. I took the money that came in from these assets to pay my premiums and to pay back loans. In 2024, I refinanced it it got valued at 30,000, sorry, $300,000. And we were able to take a loan to value of 75% on the refi. So I took out about $100,000 here, and I used this to fund a second policy. If you guys were here for when I did the Black Belt Boot Camp with Jason, we did 1 week. I showed the strategy that basically I used using it with my business. But this is the same policy. I took the money from a refinance from that deal that I did in the first place with my first policy, and I also paid my policy with the rental income that came from it. I used it to leverage it to now put money into a new policy. So a big dump in, and then the 15,000 a year, it gets paid by my jiu-jitsu school. Every quarter, I pay this one quarterly. I was able to take out that 100,000 pretty much immediately within 30 days. And what I did with it is I finally got my asset stack going. I use it to buy and build my jiu-jitsu school. It's basically been my dream to have a jiu-jitsu school here. And my other dream has been to have a farm. And I'm going to show you guys how I chain all these together, where when money comes into me, whether it's from my job or different, when I do deals, profits, sales commissions, whatever I got going on, teaching jiu-jitsu privates, take that money and put it into my policies. My policies get leveraged by the bank. And I have a captive customer. I have my jiu-jitsu school, which borrows as much as money as, the bank is willing to lend. And I use that money to go and get more members, invest into the facilities, the coaching staff, our systems, and to grow the school so that we can bring in more members. And then that's the cash flow that gets recycled back. But that asset also pays for my home. So the monthly mortgage on my farm, I'm able to pay myself from the jiu-jitsu school. Not all of it. It's not a point where it's completely covering my whole mortgage on the farm because it's pretty high with these mortgage interest rates, but we're getting there, and I'll go over some of those goals. But it cost me about $40,000 to open my jiu-jitsu school, and so back from this here, the cash value was 106,000. I basically took half of it and I used it to open the school and just paying off some business debt. And currently the net cash flow is with 40 students is about 3,000 per month. So I pay the expenses, then I have about 3,000 per month the way with the number of students I have. The goal for the end of the year is to get to 100 students and to have 9,000 a month in cash flow. And then that's going to help me pay for my farm. So I had shown this diagram. It shows how the money flows from using it in a business where I put the money into a policy. The policy is then leveraged by my family bank to loan it to my LLC. Now the jiu-jitsu school goes and gets revenue from customers, okay? And my operating expenses, see how it's red? That's money that's leaving my family forever. I want that to be the life insurance money. So it originally came out of the life insurance policy, take that, I loan it through, and then that's what gets paid like for the rent, for marketing, licensing. The money that comes in from the customers, I need to run that through my system first. So it's either going to go back in the form of a loan repayment, or I have to claim it as a profit, and then I start putting it again into the system. Okay. But part of this operating expenses here, some of it is like my salary, paying the rent, and that some of that money is going to be going to paying for my farm. So the startup cost for my farm, I was able to do a 3.5% down payment, so it was about 30,000. It's a 1920s farmhouse, and it needed about $50,000 in renovations. No, I'm sorry. We got quoted about $250,000 for the renovations it needed. I got it done for 50. I did it all with like pieceworkers and I managed the whole project. We purchased it for 720,000. If we were to get it appraised right now, I would assume it'd be about 950,000. Okay, so there I was able to create in my mind about $230,000 in equity. And this down payment again came from my life insurance policy, and this is the second policy. And then I'll show you guys how it all kind of just ties in together. But the estimated value on this one, I think by 2035, so we have about 12 acres in the middle of one of the most affluent parts of Newmarket, or in Frederick. It's called Newmarket. There's a lot of development going on, and we have strategies to make this farm worth a lot. So I think by, 2035, my goal is for it to be worth 2.5 million with a, just a regular single family home. I don't see a way of creating that much equity in it. So, if I'm gonna have only, because you can only do it like a 3.5% down payment on your primary residence, right? So if I'm gonna take a mortgage and I want to be able to leverage my money, I can only do it in one place. So we ended up choosing a farm, and for a lot of other reasons like growing healthy food and things. But our mortgage is pretty high. $5,800 is the mortgage. So I got to work hard to pay for it all. But anyway, so the money kind of trickles down just like this. Here's a summary of kind of everything. So it started with me making the decision to start my infinite banking journey, my financial freedom journey, by saving and putting money into a policy. I scrimped and saved for a couple years, came up with a nice big dump in, and I put that money to work immediately. I did a loan where I made $2,000 on it. I did a seller finance deal where I made about $25,000 over 3 years. I did still do Airbnb, so that's about $45,000 that I added, and a BRRRR, so buy, renovate, rent, refinance, and that brought in about 136,000 to the system. And then I ran all that money through the system and then opened a second policy. And then from the second policy, I used it to open a jiu-jitsu school, which also, and then also use the policy for a down payment on the farm. And now the cash flow from the jiu-jitsu school pays for the farm. My goal now is just to grow the streams of income so that I can pay off my mortgage and repay back these policy loans and just start to get myself into just a better position, okay? Because I have, in my mind, I've built pretty nice equity positions in my business and my property with my policies. I really like them, and every year they just get more efficient and they get better. But I want to create more breathing room with my cash flow, okay? Because it's a little tight right now, and that's kind of where I want to focus next. But I got my house, I got my business. Now it's just a matter of staying consistent, working hard. But I just wanted to share with you guys this case study. I'm a little bit different because I'm not trying to accumulate doors. I'm not trying to accumulate a bunch of assets. I just got the ones that work for me, that I can manage, that I can grow, and I chained them all together. A lot of in the beginning was just experimentation and learning so that I could find what works for me. And now just applying this thing, and hopefully I want to be a black belt in infinite banking and just money, not just jujitsu. So do you guys have any questions? Hopefully it was easy to follow. But it starts with one. And what's cool about if you get into real estate is you just need one good deal to get everything going. You don't need thousands of really good deals. You start with one, you stack it together, learn the process, and then once your policies get too big, they can't fit any more money, you can just continue to get more. Yeah, this one's really cool. Money Tree is the second year. Money Tree is a term for where the cash exceeds the cash value growth in that year. So year two, I will put in $15,000 and I can use $16,000. So this one is through Lafayette Life. This is a pretty cool one. I just got this one this year. And I have this one set up for my retirement, essentially. I stopped paying at 75 on this one. My other one's a One America policy. I go for one until age 121. This one I set it up so that it stops at 75. And that year the cash value growth is 83,000, 1.8 million in the cash value, which is really cool. That $100,000 dump in helps the policy grow grow fast, and it's like adding rocket fuel, just like those booster rockets in the beginning. You and you get really nice dividends with Lafayette. But I've done numbers, and that's nothing compared to like putting the money to work and just like compounding that cash flow. But a lot of what I my mindset has, I would say, matured more from when I was younger, where just watching my dad, he's become very successful. He's built the number one painting company in the DC, Maryland area. And in over 20 years, he's never lost money on a project. There's I don't know any contractors who have ever just not lost money on projects, but it's 20 years and we do big projects anywhere from 200 to 500 unit apartments. Some of the contracts are over $1 million, but we never lose money. And just over time, just being very rigorous and detail oriented, and then but anyway, so I just kind of try to put that, if, we put the money into policies, we use the policies to do deals where we never lose money on deals. We just stack up little profits here, little profits there, run it all through the system. Then you don't have to really get in your head too much and have to come up with like perfect plans. You can just focus on what you need to do, get the job done, and time's gonna go by anyway. And if you don't create problems for yourself, get yourself into terrible situations, it can save you. So in jujitsu, we have that where people will get stuck in terrible positions and they'll ask me, "Oh, how do I get out?" But the question you want to be asking is like, "How do I prevent this from happening again?" You don't want to keep getting put in these terrible situations. Some of the deals I did, the cash flow was so good, it's 'cause it was in Baltimore. But we've had so many problems with tenants, dealt with lawsuits. I've dealt with like some of my tenants getting murdered, like in the apartment. So it's something I wanted to get out of there completely. And now, I'm doing things with intention and sort of fits my lifestyle, not receiving calls in the middle of the night that something horrific happened. But anyway, now I'm just going on a rant. Anything else you guys got? Happy to share. If you guys go back a couple recordings, I did one about the financial freedom tracker. Okay. See you everyone next time. Bye-bye.